What is happening, best ever listeners? It's Matt Fairclough. Welcome to the best ever CRE show. And your buddy Matt is here talking about next level CRE. That's my segment here on the show, coming at you every Friday. Really good conversation today that I want you guys to check in on. Interesting stuff. Not so much CRE, it's really about alternatives, right? Because that's what we offer in commercial real estate. It's just alternatives to Wall Street. It's alternatives to what a lot of people think the only place to make money would be, which is stock investing and things offered on Wall Street. Today's really just about non-correlated alternatives, just things that don't relate to each other, and maybe alternatives that don't relate to sticks and bricks. Maybe, a lot of times you think about diversification in investing. It could be, well, okay, I'm invested in a triple net fund with my buddy Ash Patel, and I'm invested in a multifamily or a debt fund or a hotel fund with my buddy Matt Faircloth, and I'm also invested with another operator that you might have heard of too. But there's also other things that are not even real estate related that aren't even tied to interest rates, and a lot of real estate can go up and down with interest rates. So today's show is really about opening up your eyes and taking your blinders off completely to what's out there from an investment perspective. Just keep in that mind that there's a full spectrum of things that you could invest in as an LP, or the things that maybe you could provide to your LPs as an investment. Because that's really what our job is to provide things that people can build their wealth in with you alongside them as the operator of whatever that thing is. If you're an operations person, if you're a passive investor, obviously your job is to reach your investment goals at or earlier than your timeline goal would be to get there, to get there faster than you wanted to, and maybe to make even more than you were thinking. That's your goal there. But you got to do that by being eyes wide open on what alternatives that you may have. So that's what today's show is all about. Can't wait to hop in. Before we get there, let me reach into the best ever toolbox and highlight one thing. If you guys are looking, if you're an operator and you're looking to bring on new talent into your company, if you're looking to grow and scale, you need people. You need money. Yeah, I know. You need deals. Yes, I know. But you also need top tier A+ people. And I'll tell you a place that you can go to find those top tier A+ people to help you get your company to the next level. How about the best ever community? How about people listening to this show right now? What if somebody listening to this show is your next key operations person, your next integrator, your next investor relations manager, your next acquisition specialist, your next insert the person the superstar you need to get your company to the next level? What if that person is listening to this show right now? Well, look no further, guys. Go to bestevercre.com/talent. Bestevercre.com/talent. And our talented best ever CRE talent solutions team will help you find that A+ person. Because why not reach into a community that you're already plugged into, this best ever community, to find someone who's also plugged into this community too, that is going to get where you want to go as a company. Bestevercre.com/talent. Go check it out now. Now let's hop in with our guest, Patrick Grimes, to talk all things alternative investing. Best ever listeners, we've got a great guest today, and I'm really looking forward to bringing on Patrick. Let me tell you a little bit about Patrick. Patrick's the CEO and founder of Passive Investing Mastery, and he's also an internationally bestseller, Forbes Council contributor, serial entrepreneur. He's also a nerdy engineer, just like me. I call people like me and Patrick to be engineers in recovery, recovering engineers, now real estate investors. There are dozens of real estate investors that are former engineers. Patrick's way smarter than I am because he's a robotics and automation engineer. I dodged it and was just industrial and systems and that kind of thing. He's based in Honolulu, Hawaii. If you guys are watching live, he's got a phenomenal Hawaiian shirt on right now. So Patrick, I met you years ago at a multifamily and syndicators investing event. And then I'm really grateful to have you in my circle and that. So welcome to the Best Ever CRE show.
Same here, Matt. I've really enjoyed hanging out with you and our other chummy guys that were all out there fighting the good, doing great investments. And we've had some really fun times at our mastermind events.
So I love hearing former engineers' story on how they all of a sudden light bulb went on and said, this engineering thing's great, but let me try something else. What was your light bulb moment as an engineer that got you transitioning over to investments?
So I was a mechanical engineer. I started right out of college at a machine design firm, and it was a lot of fun. I was doing well. I started getting some bonuses, and I didn't come from wealth, so I was saving up. I literally was transferring part of every single paycheck to a separate account in some odd bank called Umpqua Bank, and started saving up my bonuses and my raises. And I talked to the founder of the company that I was working for, and I said, "Look, we're doing a lot of fun stuff with startups and stocks. Where should I invest? Because I really want to do well for myself." And he said, "Hey, real estate." I'm like, "What?" And this is a guy who's, tech titan, had a company running for over 30 years. And he said, "Yep, I make all my money in high tech and I put it in real estate. And my only regret is not doing more sooner." And that was a surprise to me. I didn't necessarily see that coming. I knew I wanted to invest, and that's what got me on the path. It was a rocky road, by the way,
Yeah.
but that's what got me pointed in the right direction.
That's great. That's great. That's great. I was like, he's going to tell me Rich Dad Poor Dad, because it's like what everybody that's like, "Oh, how'd you get involved in investing?" He's like, "Oh yeah, I read Rich Dad Poor Dad." Yeah, that's what happened to me. My girlfriend, now wife of 20 years, put Rich Dad Poor Dad in my hand. I'm glad you had another answer. My guess is that coworker of yours probably read Rich Dad Poor Dad, and that's how they found out about it.
Well, I read Rich Dad Poor Dad after the fact, but yeah,
There you go.
and I had hundreds of other books, and I do talk about that purple book a lot. And
Yeah.
it was absolutely, I want to say, just a paradigm shifting moment, because came from a family of educators.
Oh,
My dad has 3 doctorates, and so my mom ran
your
some
dad was rich. Your dad was Poor Dad, because remember, if you read the book,
exactly, and he
yeah,
just
yeah.
loved everything in the sciences, and doctorate in divinity, doctorate in evolution. I mean, we're talking all kinds. Just I was raised in such a really phenomenal way, learning the sciences and religions all at the same time. But my sister, she's a clinical psychologist, a tenured professor in San Diego, and runs the clinic. And I came from a family of educators, but I was the engineer, and I wanted to find ways to diversify, and I wanted to build financial security. So I took a little bit different path.
That's great. That's great. So you said your first couple real estate deals were not no cakewalk, that kind of thing. What were your first couple deals? Recovering engineer, a coworker told you to get involved in real estate. What did you stumble yourself into at first?
Well, I was pretty much indestructible back then in my younger years, right? I thought I could just
Weren't we all? Yeah.
get rich quick and dump it into the highest returning deals I could find. I did a lot of research. I found some operators and some asset classes, some strategies that doubled and tripled their returns pretty quickly every other year. And so I was like, wow, let me jump on this train. I bought into a pre-development at the time, and turns out it was somewhat speculative.
Mm.
And I have the unfortunate reality of having been born at a time which got me right out of college just before the subprime mortgage collapse.
Oh
So
yeah.
in 2009 and 10, I was crawling out of recourse debt, and the banks were coming after me. I was able to do what's known as debt forgiveness, and I did go through foreclosure, and then that debt forgiveness ended up becoming a 1099 that the IRS came after me for as income. And so then I was paying on income for the forgiven debt, and it was, tell you what, man, I was young, so I knew I could financially recover, but my ego was bruised, my credit was bruised. I was pretty battered coming out of that. So
And
it took me,
any best ever listener that got involved in real estate investing like 10 years ago or less has no idea what you're talking about. I remember that, because I used to do short sales back in the day in like 7, 8, 9. And I mean, that whole thing about debt forgiveness, man, what a freaking like a backdoor, kick in the butt that it was for these people that were selling properties short. Like I work with a guy that he owed 400 grand on a property. Because the bank agreed to take the write down and they didn't want to just foreclose on it, they agreed to take a payoff of $100,000. So a $300,000 write down on debt, right? And so at first they were looking to report it to the IRS as debt forgiveness. I mean, what a freaking right uppercut to this guy, you know?
yeah, and they don't
Yeah.
tell you that. Nobody told me that what was going to happen in the subsequent year was I was going to be paying on taxes without any income, on the backs of having already dumped everything I had into something and using every extra penny I had to keep it afloat as long as I did, because I didn't want to go bankrupt. I thought I was doing the right thing.
Yeah. Yeah.
People that went
Yeah.
bankrupt, they actually turned out a lot turned out a lot better for them than it did me. But I still can say to this day, I was able to avoid bankruptcy, which I'm pretty fortunate. I worked hard to be able to make that happen.
Yeah, 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 yeah. Well, a lot of the best have had to say the B word at some point. It's not even a judgment call. It's just something you just maybe at some point you get it back in the corner. You got to do it, and that. But I'm glad you dodged it. So then what? So you do the real estate thing, debt forgiveness, right uppercut, and everything like that. Somehow or another, you survived and lived another day and made it all the way out to Hawaii. So what? Where did scale start to happen for you in your business?
Well, I was still a successful engineer, and I
Oh,
decided, look, man, I'm just going to climb this corporate ladder. I'm on my way. I
yeah.
had the being, my family drilling in education. I had forethought to negotiate into my contract that they would cover a master's degree, and so I went ahead and enrolled in a dual master program, and so
There you go.
I got a master's in engineering and an MBA. My sister is very quick to remind me that one PhD doesn't equal two masters. So unfortunately, I'm a younger sister, right? But so I started climbing the ladder. I hopped over to a smaller company where I could be a bigger fish, got a, executive level type position as a director at that point. And then I was doing some really awesome projects with Tesla and Lockheed and J&J and Abbott. And we were doing
Mhm.
automation for like the rotor assembly for the Tesla. I can't talk about what I was doing at SpaceX, but that stuff just blew my mind. We're doing
Cool.
satellite solar cell assembly stuff, even diagnostics of catheters that go into the heart and ablate for nerves that are causing arrhythmia. So much fascinating stuff. I was doing really well, and then I was back to that same place again, Matt. I was like, hey, look, I've got capital, got where am I going to invest? Got these bonuses coming in. And I just followed the breadcrumbs of the wealthy back to investing, and it led me back to real estate, but in a very different way. I
Mm.
learned about recession resilient markets. I learned and I zoomed out over decades to find where real stability was. And I actually landed on Houston, which didn't even care almost that the subprime mortgage collapse happened. The values stayed stable and went up within just a matter of a couple of years. Whereas in some markets, like where I was at in Orlando or in Phoenix, it didn't recover for 12, 13 years. So it's a very real thing. And then I purple booked it, right? Learned how to buy assets for cash flow, not speculative assets where you get rich quick. But I started buying the most longest term appreciating stabilized assets were 3-bedroom, 2-bath. And I started doing a portfolio from California, the Burr method. I didn't know it was the Burr at the time, but I was buying, renovating, refining, and renting, and then repeating this single family portfolio. And it was working. I was tough because I was moonlighting it while flying around. And ultimately, you asked about scale. That didn't scale. I mean, I was working, but the single family, it was brutal. And I
Mhm.
ended up, when I met what now is my wife, I told her I had to stop doing my investing, and I had to take a break and I take a step back. And she was there for my very last single family closing. It wasn't for another couple of years. And one of our buddies that runs the masterminds that we go to, I heard his podcast talking about all the benefits of apartments and syndications. And that's what led me into apartment building syndications. That just gave me a bit more scale.
Mhm.
Led me later on to getting into more alternatives. Keep in mind, I was looking to diversify out of just the stock market when I got into real estate. So from real estate, we got into energy. And then from energy, we're in the legal industry now. And we've got private credit and various private credit and acquisitions and commercial real estate. So we've got a very diversified portfolio at this point.
Yeah. A few things I want to unpack. I've heard a few people say this data point, and I want to make sure the best ever listeners caught this. It's just an interesting conversation about the 3-bedroom, 2-bath. You had said that it's the most appreciating single family home investment. I've heard that it's the most sought after. If you're a landlord and you own a single family, if you want to buy a single family home, the most sought after equation for a single family home by a tenant is a 3-bedroom, 2-bath. Is that like, can you unpack a little bit about the data there and, like how valid it was for you?
Yeah, so I've heard some challenges just since COVID that has changed
Mm.
slightly because more people are working from home and
Ah,
seeking more home offices. But pre-COVID, forever, 3 bedrooms, 2 baths were the most highly sought after. They're the last to decline in a recession and the first to recover.
Hmm.
And those are what are the most recession resilient or stable asset classes. And then between 3 bedroom and 2 bath, from an investor perspective, there's literally nothing until you get to about 80 units or above. Because
Yeah.
at 80 units or above, you get past, you get to an economy of scale, which finally outweighs that stability, because now you can have on-site property management, you can
Mhm.
renovate unit after unit, and you can get non-recourse debt. But in my mind, in my calculus, shared by many others, there really was nothing that made sense between, in the residential side, not the commercial side, because we also do industrial and manufacturing, warehousing, and retail. But from the residential side, there was nothing between a 3 bedroom, 2 bath, and an 80 plus unit building.
Yeah, I know. Yeah, I've heard many people. I've heard horror stories. I've heard success stories. I've bought small stuff like 18 units, 10 units, 49 unit, that kind of thing. But yeah, man, management is a thing on those kind of properties, because you do. It's like a weird thing. You need management to have that many residents under one roof. You do need to have some sort of management protocol systems. You're going to have everything from common areas that need to get cleaned to somebody's going to need rent to get collected. There's always going to be a maintenance thing or something like that. But the asset's just not big enough to afford to pay the staff that needs to occupy a leasing office, right? Show me a 10-unit building with a leasing office that's charging, market rate rents, right? Just doesn't exist. So that's interesting. But I've heard people that are successful with it, and I've heard people that,
Mm.
bought it and just because of the management problem. That's the problem, management. Because of that, they've been unable to make the asset work. Did you ever own anything in that range, or did you intentionally avoid it, as you just said?
Well, so I have technically, yes, but they were part of a two property portfolio that got us above 80 units with two properties that were
Okay.
close together. And even that spread was difficult. And to your point, the management companies that try and do these assets that are kind of below 80 units or in the 40 unit range in some markets, they will charge like 12, 15, 18%, but you still don't have on-site management. So you're struggling to call them just like you would in a single family home. Please go look at my asset, or there's emergency at my asset. So it goes from a chasing somebody who you potentially don't own their time, to try and get them, and they're taking a small sliver away from you and many others, and you're dueling with essentially all these complexities of trying to get their attention, to where when you finally get to 80 units, they work for you, they're calling you, they're looking after you, and there's an alignment of interest. And at that point too, I get the other factors are the economy of scale, to be
Hmm.
able to manage that amount of units, to have that leasing and maintenance, right? Because now you're not paying top dollar for all your maintenance fees, but also you can get real non-recourse debt. You can get real, because now the assets are large enough. They've reached this critical mass where the lenders are saying, no, we can value this based off its net operating income. And we can give you, it's low enough risk for us at this point, because it's an income generating business, that we can give you much more advantageous debt for it. And so there's really like that in my mind, it's just there really, I didn't because I couldn't make the numbers work from numerous different perspectives in between those two.
Hmm. Yeah, yeah. No, I get it, and it's about, like, as an investor, I think it's like, if you can figure out how to solve the problem, how to solve the equation for where that be that for, let me buy two properties that add up to 80 units, as you said. Maybe I can run a leasing office out of one and kind of spread the payroll across both of them. For me, it was like, let me buy a 10-unit apartment building, but also let me buy a bunch of scattered site that adds up to well more than 100 units. And I could have my own team in house, so my own leasing agent, my own maintenance guy, whatever, to keep costs down. But there's whatever way you solve that equation, there's certainly it's not going to be easy, but if you can figure out a way to make it work, that's the way you're successful in those weird numbers. And yeah, it is weird, but there's a way to make it work, but you got to get creative, I would think. It's not going to just be a plug and play kind of thing. So do you currently own any residential stuff? Have you graduated beyond that? I know you're involved in other kinds of other things now, which I want to get into, but are you still involved in residential at all?
I just in the last couple of years sold off the last of my single family, but I am a partner in a couple thousand apartment buildings throughout the southeastern states, eastern states, and Midwest.
Okay. But you've transitioned into other alternatives, right? Why did you started out multifamily, but somehow or another, maybe it was a curiosity itch, or just the desire to create diversity for your investors, whatever it was, you chose to expand out. of multifamily. What is your company investing in now?
Well, so the reason why I was in this to begin with was, man, I was heavily indexed in high tech, and the advice that I got was, I mean, where else should I invest? And it was in real estate. The idea was I needed to be diversified, right? And especially after seeing a downturn happen, what it can be like when you're all in one industry and you saw one market swing collapse, right? You or me, and then you just have this very rude awakening that you don't want to be driven by one market, right? You want to allocate your investments across multiple different markets where you're not driven by the same fundamentals. Like fundamentally, all of real estate is going to be affected by interest rates, right? Similar, or like by a pandemic. It's going to have a really tough time because they're going to ride same rate. Whereas other industries like energy, where you have oil and gas, well, those what we call are non-correlated, or healthcare. They need doctors, they need health services, whether the markets are good or bad. Plumbers, CPA firms are all needed. Those are all the types of what we call non-correlated and somewhat recession resilient. They're not dependent upon the market factors of broader market fundamentals of broader investment classes. The legal industry is one of my favorites, and that's why we're really focused in that, because it's just steady, tried and true. Like nobody really, if you look at the numbers and you look at our decks, attorneys just simply don't care what's going on in the stock market, real estate, oil and gas, gold, interest rates. They just simply couldn't care any less. Their business just continues to grow. They still get paid in good times, and even more so when people get really litigious in bad times. So it's just one of those industries where you can say, look, I'm kind of on a wild ride with my stock market. Real estate's kind of wild. Man, oil and gas is most certainly wild. It's not correlated though, so it's good allocation. But are there other investments which have more stability, recession resilience, and aren't going to ride the same waves? Of course there are. And that's why we educate in Passive Investing Mastery about these, what we call non-correlated investments for real financial security, not just independence like I had. I was financially independent in real estate. Well, that can disappear. That's not much security, right?
But how do you make money with, like, you're not going to go get your law degree, right? You're a smart guy, but you're not a lawyer. How do investors make money in the law business?
Yeah, like any industry, if you want to participate in the market fundamentals, right, you've got to figure out how to solve a need. And like we are in real estate, I'll draw a parallel for you. We are lending to operators so that, for example, they can buy a property or improve a property to provide housing to tenants. And that's an asset-backed lending strategy. Very analogous to that, there are operators in the legal industry. These are attorneys. These are attorneys that some of them are working on a contingency fee basis, meaning these clients that they're helping, they can't, just like a tenant can't maybe buy a property themselves. These individuals were harmed, but they can't afford their own access to justice. They can't afford the cost of attorneys to go through litigation, which is a process by which they can get access to justice. And so these attorneys are servicing these individuals that otherwise wouldn't be able to get access to justice by working on contingency, not pro bono for free, but meaning when they win the case, the attorney gets to participate. In our case, usually it's 40, 50% of the proceeds, right? But these attorneys, this is a huge industry of contingency fee based. Turns out there's a lot of harmed individuals that can't afford representation. But how do the attorneys do it? Well, they come out to asset-backed lenders like us. They're experienced.
Let me unpack that, right? Joe Smith gets in a car accident, and it's like a fault of someone else, and maybe like a big company guy driving a dump truck or something like that hits a car, car's damaged. Unfortunately, Joe Smith gets injured, so he's got an injury claim against a company that is clearly liable, and Joe Smith has a case. Unfortunately, he doesn't have the money in his pocket to hire a local lawyer to go and pay for access justice for him. I love the way he said that. He doesn't have the money to do that, so he needs to get his lawyer to go and take the job on contingency. Is that what it's called? Meaning, like, if I get you $100,000 in a settlement, I get 20%, 30%. The attorney gets paid as part of the settlement. So it's like a win-win. Did I say that right?
Everything you just said made sense. However, the specific example isn't something that we participate in. But yeah, the intent is typically in our world, it's hundreds or thousands of harmed individuals that, for example, we just won a case with the LA Juvenile Detention Center, and you can look it up, LA Juvenile Detention Center sexual assault settlement. And for many, many years, there were individuals, children in our juvenile detention center that were harmed, sexually assaulted, and they just settled in the last couple months for billions of dollars to provide these what's called a mass harm or mass tort, mass harm against one big evil organization or company. And so we just announced to our investors we got a great settlement coming back through providing access for propping up these attorneys, allowing them to serve. Another really good example is Camp Lejeune water contamination. We're in that too. So we don't really do kind of this ambulance chaser like personal injury or DUI or whatever that stuff. We do like large scale stuff. So yeah,
you're not funding the guy when I'm driving on Route 95 in Philly and I see are you injured? If I see that, because I don't know what it is about like highway billboards, but that seems to be where those ambulance chasing attorneys love to advertise. So you are not funding those guys that have all the billboards I have to look at when I drive to the airport in Philadelphia. No,
like if you know about Camp Lejeune, I mean that's
good to know. I'm not a fan.
That's a hallmark case, for example.
I've heard of the Camp Lejeune case.
17 years, the DOJ fed contaminated water to our military, civilians, and families that were there on the Marine base, Camp Lejeune, as they were training to go to war. And it caused horrific illnesses. And there was federal agencies, the Disease for Toxicology, did studies to show that contamination causes the diseases. And the United States government, Biden signed the Camp Relief Justice Relief Act, and the U.S. Judgment Fund was put as the fund to pay these claims. And they were even released a grid saying, based on how long you were at Camp Lejeune and your health record symptoms of what your condition is, here's your settlement, right? And so up until last August, we could allocate to attorneys and then help them. They did close down the settlements last August, help them identify who these people are, verify that they had proof of exposure, verify that they had the medical records with the condition, that they qualified, and we could contribute towards the attorneys to give them funds to get these people across the finish line to participate in part of the settlement. That's about as strong of a case as you can get. There's a lot of others, but those are the types of cases we call really late staged, either single event or very late stage. We call it mass tort, where there's hundreds of thousands of people harmed by a single defendant, where we're at that point, it's more about when are they going to settle and how much than it is like, are they actually guilty, right? At that point, it's hard to make cases.
Is that why? I mean, I get you're making more, I mean, not to make it about this, but it seems to be a real societal benefit, like a real wrongdoing to large groups. Obviously, that's probably a better investment for your investors. And also, who knows if Joe Smith getting into a car accident is going to settle or not, who knows? And so maybe it's not a good return, but also it's not as much of an impact. And I'm sure that they can figure that part of it out. So your fund is funding the lawyer and his or her overhead expenses to pursue things for clients that are part of a large tort case. Just because the lawyer, they got to pay their bills, they got to pay their rent, they got to, get compensated for their overhead and their expenses to pursue that case. So your fund is providing that lawyer with compensation so they can pursue. And then what does your fund get as compensation for fronting all that money?
So we do a financing agreement similar to how we do in our real estate investments. We underwrite the attorney for track record, liquidity, capability to execute on the business plan, just like you do with the real estate operator.
Yeah.
We then have in real estate, we use appraisers, but in litigation finance, use law firm valuation specialists. So we have a third party come in, review the attorney's what they call docket, which is their list of clients. We do samples of it. If there's a lot of them, we'll do a sampling to verify that they have all the right files with the medical records and proof of exposure, and the intake was all done, that they do in fact qualify. And you can hire companies to value the corporate collateral value, that asset, that corporate asset value for each of those contingency fee agreements they have. And in real estate, people will lend 50, 70, 80, 90%. In our debt fund, we're like below 60. But in real estate, they'll lend a lot. Litigation finance, we're in that 10, 20, 30 max. So we'll lend on a value of that collateral to help the attorneys either do usually one of two things. We'll help them because they're doing marketing to try and find more similarly harmed individuals. We'll help them pay for that, because the more people they get, the more profitable it is for them, right? And the scarier they are to the defendant, so the faster they'll settle. So that's just like helping a property owner buy an asset. Or we'll lend for operating expenses, right? Well, we'll collateralize their existing cases and we'll lend to operating expenses, which is very similar to CapEx expenses to improve that collateral, whether it be the collateral in real estate or the collateral in legal. So it's very similar to any kind of asset-backed lending structure. Now, I say borrower and lender, it's not necessarily borrower and lender in our case, because we use something called a prepaid forward contract, where our returns come back as capital gains as opposed to interest income. And the investors can enjoy that. And we don't just get principal and interest like you do in real estate, right? Where you just have a balance and this interest rate fixed. It is more of a waterfall type return in our structure. But then there's a lot of different versions, but in our particular structure, it's either a split of the contingency fees in some locations, like in Arizona, or it's a waterfall structure where we get the majority of we get all the proceeds to a certain amount, get our capital back, and the attorney gets nothing. And then above that, we have an aggregated split where we get 75 and 50 and 20. So you're able to participate in more of the upside. And as the case does better and better and better, you get to participate in quite a bit larger returns than an asset-backed lending structure in real estate.
So it's not something that cash flows, but this is like a big appreciation pop that hits when the case is settled. Am I reading that right?
It's a really good question, because in real estate, the underlying asset value is you're giving housing to tenants and they're kicking out rent, right? And then in litigation finance, in our version of it, where there's a contingency fee-based attorney, that guy can't afford, that individual you're helping can't afford access. So we're helping to pay the attorney's rent and operating expenses. So while an underlying asset doesn't say cash flow, the reason why you do a large pool, we have a diversified litigation portfolio with thousands of individual lawsuits across lots and lots of different cases, is because those are going to settle over time. Say in a 5-year period, you're going to have some, we aim for ones that are going to settle in 2 and 3 and 4 years, maybe on the outside 5. But in this time, you're going to have hundreds of those cases settling during the middle and towards the end, unlike a real estate deal where it's all back ended and you're waiting for either one refi or one sale, and you have to wait and hold your breath. In our case, really, it's sort of a middle loaded, where each quarter, whatever settles comes through. We don't publish like, here's your distribution schedule, because it's not steady Eddie rent checks coming in, waiting for a pop at the end, as you said. It's really 1,000 little pops, statistically kind of distributed throughout the life of the fund.
Because you've diversified, you're not like going all in on the Camp Lejeune deal. You've got other investments that you're making, and you're spreading yourself out so that the pops are coming as micro pops that are able to pay more regular distributions. Right?
We have ones in infant baby formula, ones in where toxic baby formula, really really rough stuff, PFAS, water contamination. We have allocations into all kinds of different things, including like some labor claims. I've told you about the sexual assault, numerous sexual assault.
Yeah,
well, there's just a lot there, and you're right. They kind of follow this theme of like doing good, because they're not this predatory type litigation or frivolous lawsuits. It does create social change, and that's, I mean, just like in our real estate syndications where we say that we provide a cleaner, safer, and improved living experience for our tenants, right? And great non-correlated returns to our investors. We have to look for the same thing, right? In any of our investments, it is not an impact or an ESG investment, but it happens to be that funding for these kinds of cases does have a good impact. And
you're helping out people that don't have the means.
Right.
These people might not have the means to access to justice. I just love that phrase, and I keep using it. So how does the fund typically, what does something like this perform at financially on average, looking historically back?
Well, So I got to be real careful because litigation finance is a huge industry. It's like the size of the global airline industry, just to be clear.
Wow.
It's just maybe you haven't heard of it, but it's been going around since 1910. I mean, the first litigation finance third-party funding of a large case in America was when these people were walking around smoking cigarettes saying, wait, you know what? I don't know if these are healthy for us. We're all dying of these horrific deaths. I think
Coughing a lot.
American tobacco is lying to us. And that was the very first, and they settled for billions. Again, social change. That was the very first case here in America. But got to think about it, got to back out. Like, just like real estate, how you can be like what I did in 2008, 9 and gamble big on a pre-development and try and get, 100x returns and get rich quick. You can do that same thing in litigation finance. You can do that same thing in angel investing and seed investing and wildcat oil and gas drilling. Every investment has this purely speculative, like lose it all or get rich quick. And then every investment has this really, really like very much lower risk tied to the spectrum. In our case, it could be receivables. After the settlement's been announced, you're just going to invest in the receivable from LA County or from the DOJ. And then, but where we're at, what we like to call it's called late staged, where it's not huge, speculative, risky 100x returns. It's not, high single digits or low teens receivable returns. It's more in that like 20 to 30 internal rate of return. While it's before the judge gavels down or there's a settlement announced, we're indicating we're trying to be as close to last dollar in, help these attorneys get over the final steps, either by increasing their client docket numbers and helping them market or giving them some of that final CapEx when you can see the whites of the eyes of the settlement. Causality, what they call in liability, has fairly been established at that point. It's more about when and how much you're going to settle for than it is if, right? And at that point, it is the case that 90% of civil lawsuits settle anyways. So it's not really that binary risk as much, right? And so that gets us that sweet spot, which has worked for us, right? Because we were in a really strong position at Camp Lejeune. We have a real strong position now in the sexual assault. And that's where you kind of get that outsized return for a little lower risk.
Mm-hmm. Yeah, it really kind of goes back to risk profile. So if you're able to make a better return than the risk profile would dictate that you should, that's really where you win. So great. So you seem to be this guy's a lot of data. If I may read you a bit here, and in my knowledge of you, knowing you over the years, you do a lot of data, a lot of research on ways to make money alternatively. So like outside of Wall Street, and maybe outside of sticks and bricks too. And then that's okay. It's okay to still to talk. You can make money out of like in non-correlated investments and things like that. What other asset classes do you like these days? What's Patrick thinking about that are asset classes that are out there that you might decide to investigate further? If you don't mind me kind of looking into the future with you a bit.
Yeah. So, I mean, you look at the condition we're at here right now, macroeconomically, me having been through a downturn before, looking at it's very interesting to see how things are going to play out. 11 out of the last 14 Fed rate hikes, 11 out of the last 14 Fed rate hikes ended in a bust in the market, right? So we're already in a position on very precarious footing. Now, what else could cause market instability? Well, we just got done with the pandemic, right? That it disrupted supply chains. We have inflation that did a rapid increase, right? That could cause issues. We also have an actual trade war going on with the world's largest economy at a time when our spending has been spiraling out of control, could also cause a recession at a time when the dollar value is being challenged by the world's biggest economies. Also, on its own, could cause a recession at a time when we're in 2 proxy wars. Also can cause a recession. And we're now just in a real war with Iran having bombed. And maybe I'm dating the podcast. But you look at the vast number of individual singular events which could cause market instability all happening simultaneously right now. It always, Matt, is the right time to diversify into different investments.
It's the right time to go hide in my closet, or can I go go hide under my bed? From what you're talking about, man. Good Lord.
I'm just saying it's always the right time to diversify into non-correlated investments.
With all the things you just spelled out, right?
It's exactly the right time, right? The best time is 2 years ago. The second best time is today. So I get the most frequently asked question I ever get is this question. And actually, investwithpatrick.com, I have a whole PDF I've written, Patrick's favorite non-correlated investments that you can invest in today, start building independence across different market fundamentals at investwithpatrick.com. And the first page just lists them, and the next 30 pages digs into each of them separately. And so that happens to be, because we are Alternative Investing Mastery Series, we literally present each new investment, a completely new strategy every 2 weeks, just a blue ocean approach to these. And so I've put my favorite ones, but it depends on where you're at as an investor. It's not possible for somebody like me to say, hey, here's the end all for everybody. Different people are at different stages in their life, right? They have different allocations. And again, the right investment portfolio is to diversify in a way specific to your current portfolio, in a way that helps to build more resilience in your portfolio, whether you're all in the stock markets, you're just in bonds, you're in real estate, or maybe you're in some oil and gas. But we are, if you look at that list, you're going to see things like energy, and we've done some energy. In fact, my great-grandfather did energy, and my parents are still collecting on modest royalties from that. So it can provide generational cash flow. I've done some oil and gas drilling, and you have to have the stomach for it. I've invested in some of that stuff, but I'll tell you what, that's cash flowing right now when you see commercial real estate in a downturn, and it's having a very tough go of it. And the vast majority of deals are not cash flowing right now. That's an example of non-correlation. My precious metals, my gold and silver, are up like 80% since, that is a store of wealth, right? That is inversely correlated to the dollar. And so I have strategies that I implement and I educate on about, well, how much should you have in the bank for emergency? What part of that should be in a cash equivalent? And how's that served me well? While the dollar's inflating, my gold is skyrocketing, right? There's other ways too to join macroeconomic. There's, technology metals, and we've educated on what are those things and how can you invest not just for a store of wealth, but for growth. The litigation or legal industry, healthcare, CPA firms, and weird things, novel things like life settlements. What are life settlements? Well, those are not correlated to anything.
No, go there, man. I got some friends that are involved in that stuff. Did your company do life settlements?
No, we don't offer life settlements. It's one of those ones where you have to have a huge built out structure, but that is a kind of allocation you can make into somebody who that's all they do is that specific.
I have some friends that are very high net worth individuals that do it on their own. Like they're not in a fund that's doing a life settlement. I don't know if you care to just for the benefit of the best ever listeners to, and I'm sure they can go to investwithpatrick.com and maybe read up more about it there. But would you mind just like, let's go a minute tangent and unpack real quick what a life settlement is and how people make money with it?
Well, when you're talking about non-correlated investments and ones that don't have the same market indicators, right? What is a life settlement? Somebody gets an insurance policy, a life insurance policy, right? In very simple terms, they're going to pay a premium, some of them until a certain time, and some of them until they pass, and sometimes the premium goes up. What happens, unfortunately, and this, I'll be honest, this actually happened to my parents and they never even told me. They had a life insurance policy. They got later in years and they made the decision without telling any of his kids that they were going to let it lapse. And why is that? Why? They said, well, you know what? We want to travel. We want to have a good time. This policy is now a liability for us. And the amount that they were going to get at settlement over time, it felt like it was less and less valuable. They were paying a lot of money for what they thought when they got it was going to be a lot of money. And now it doesn't seem like so much. And so they found that like we have these pensions and we have these, we'll be fine without this. So they let it lapse. What's interesting though, is that there's now a law out that when somebody defaults on their life insurance policy, which these life insurance companies are counting on happening, that they're required to send out information that can be sold. They're required to notify that individual that they can actually get a cash value for not all, but lots of types of life insurance policies. There's an actual cash value, and the life insurance will buy it back at a percentage of that, or the whole cash value, or other investors will buy it back for more than the life insurance policy will, the life insurance company will. And what does that mean? That means the investor now owns an asset. They get assigned the benefit, the death benefit. They're on the hook to pay the premiums, But that's more of a calculated risk because there are actuaries out there that look at the health records. And I think life insurance is in moderation is a good thing. I have a 2-year-old, right? I look out for that. But there's those out there that look at, millions of data points, and they make a statistical representation of your life expectancy, the premium out, and they underwrite. And what market fundamentals will drive that return, Matt?
Mm-hmm. Well,
Nothing. No market fundamentals will drive that return, right? It's completely uncorrelated.
It's. I mean, in like, you joke about like what industry the person's in or something like that, but yeah, it's completely uncorrelated to what happens in the economy. To be straight, I mean, you're kind of placing a bet on when someone's going to die, which that was what made my stomach turn a little bit about it. But you're on the other side of it from a layman's terms perspective. If somebody's got a insurance policy that might have a $2 million death benefit when that person passes, they just don't want to make their premium payment anymore because it could be significant, especially for someone who's older, right? They can get a check, and not all of the $2 million, but they could get a large portion of it from an investor they get the $2 million when the person does pass. So maybe if you look at what it's doing from a real like time value of money perspective for the policyholder, it's probably a pretty good deal. They're probably putting a couple $100,000 in their pocket today, and then the investors getting the death benefit, whatever the death may occur. I get it, but it just kind of it felt just I don't know. I don't know why I had the opportunity to look into something like that. It felt a little skeevy. Are you, and you're not invested in those? Why are you not? For the same reason, or just it doesn't match your portfolio, and why are you not in those?
Well, so in any industry, as you said, skeevy was a word. In any industry, there's skeevy ways to operate, right?
100%. Yeah.
But you got to look at the statistics from the life insurance companies. They're actually hoping that and some of them are set to actually grow. They're hoping that a large percentage of these lapse, and the majority of them do lapse. And This is a very interesting data point. And so you're jumping in to either, one, prevent that from happening, so they get some benefit. Two, you're giving them more than the insurance company would, because they're going to have let that lapse anyways, right? Or take a lower amount. And three, a large part of these are because near end of life is when they need the money for healthcare, they need the money for housing, they need the money for, and sometimes it's that next of kin saying, look, hey, look, I just can't afford to take care of my mom, or I can't afford for their living expenses anymore, or whatever it is. Can we? And it's the kids saying, look, can we do something to make sure that we can take care of them until they pass? And so that's a lot of the cases. But of course, in every industry, there's predatory people.
Well, when you put it like that, you actually did. You shined a nice positive light on it, and I think that you're right. It is about perspective. So thank you for that.
So I'm not opposed to it. I have several that I'm eyeballing right now, and I am planning to allocate into it. It's just right now, as I've said, we've got incredible opportunities in commercial real estate and in income and acquisitions, and also legal funding. One of the things you got to watch out for with life settlements is that it's what we call a negative carry, right? So the longer this person lives, you're still paying out, right? Yeah. So it's kind of like it doesn't not only does it not cash flow, so it wouldn't reach Robert Kiyosaki's check. You got to be essentially ready to be capital called every year until the person passes, right? And so it's kind of a different structure that works for different people at different times of their life, right? And for a different allocation. And so there are people out there like, look, man, I've got a ton of money over here and I'm investing in these kinds of assets. They're like, yeah, if I have to pay a couple grand a year or whatever it is to keep this premium going, I would love to do that, to just take one piece that's non-correlated. I'm not quite there right now, but it's a great capital preservation move, because typically the returns on those don't lose capital, but they can be they can be pretty significant or moderate, right? And so that instability kind of in the duration, the negative carry, and how long people last makes it a little less calculable for me, right? And as an engineer, with private credit deals like we're doing in legal industry or in real estate or acquiring, I can underwrite and calculate those with a lot more precision. Does that make sense?
Yeah, no, it does.
Not everybody's like me. Some people, and the hedge funds, sovereign funds, these kinds of are really big into life settlements for the capital preservation and non-correlated nature, right? They're just in a little bit different situation than I personally am.
Sure. Well, if you own enough of them, Right. That it's going to average out. Like the actuary is going to be right. That the average person in this scenario is going to live to be exactly, whatever it is, 72.3 years old or whatever. The averages do play. If you're a single investor in something like that, you have the possibility of the ends of the sides of the bell curve becoming real factors. The person living way longer or unfortunately not, whatever it may be. And that. So yeah, I get why coming in with a big check makes more sense. Just again, you're a smart guy. Any investment opportunities you're seeing these days in tech or in AI or in ways to get involved in alternatives or non-correlated investments in the changing economy of new developments coming into the world? Like I keep AI, blockchain, crypto, those kinds of things. What are you predicting and seeing in that world?
Well, so I'm heavily investigating right now a way to get involved in energy and not just oil and gas, but in a diversified portfolio of energy investments that is partially oil and gas and also in renewables and some of the I mean, you look at like the Amazons and the Googles, they're looking at these new atomic solutions or nuclear solutions. They're also looking at these new fission solutions that allow for, and we're right there on the cusp of it. With AI, what's happening is that the energy consumption of the world is going to double in the next couple of decades. Double in the next couple of decades. We're no longer on a steady growth curve of energy consumption. We're now on an exponential growth of energy consumption. We're already at a shortfall right now with our ability to service that, and that's going to that's going to become a major problem to the level that wars are fought over this kind of disparity in energy versus the needs. So that is one of the most exciting growth curves I think that we're going to see over the next couple dozen years. And energy, which you've got to have a stomach for it, man, because some of those commodities like oil and gas, they can go up and down. You can stick a straw in the ground, and even the best operators are going to have some misses, right? But you diversify it across other types of forms and many different opportunities. There's a really exciting time where energy right now is more exciting than it has been for several decades, just because of the demands on the consumptions driven by AI that's happening right now. So that's potentially one of the best ones. Aside from that, it's the best time to buy commercial real estate right now or lend in commercial real estate, because unfortunately we're going through what was the 2009 and 10 and single family residential. We're going through that right now in commercial real estate. So we have that's why we have two opportunistic funds doing that. Not anything that we would have done 5 years ago, but completely different things now. Lending opportunistically and buying. And then non-correlated investments. Everybody's at a different position. So that's why I always leave my calendar open. Go to passiveinvestingmastery.com and happy to chat with you. Depending upon where you're at with your pie chart, and we have lots of those on our decks, and where your allocations are, think about this market instability. What would that mean today or even in the next 20 years? What would that mean? How comfortable do you feel about your allocations? Do you feel like you have enough into industries that don't all rise and fall together to feel like you have real security, not just an independence in one or two or even three, but true security? And if so, set up a call based on where you're at, your risk profile. Every 2 weeks, we have probably over 50 different alts, which we have done deep dives, mastery sessions into with 2 or 3 experts in each of them, from a broad range of things, from oil and gas to bourbon barrel cask investing, wine to gold mining to forex to just buying planes for cash flow, lending for the disparity in pilot education right now. It's like there's just a huge number of different kinds of alternatives. We can get you, if we're not the right solution for you, we can get you pointed in the right direction.
I'd love that. I love that. It's brilliant, because just like any financial planner that's worth their salt will tell you, you shouldn't own all of one thing. You should be diversified. I know Kiyosaki talks about, that means diversify, but it's really about being in non-correlated investments, and diversifications means more than just owning Microsoft and Apple stock. That's diversification, right? No, it means owning things that don't rise and fall together. They're not connected in any sense. I really love what you've uncovered for us today. I know you said the website just one more time for those that want to hear more, connect with you for any purpose. How would they do that?
Well, if you want that PDF, which has my favorite alternatives for anybody to invest in today to begin building independence, it's at investwithpatrick.com, investwithpatrick.com. If you want to go to my website, it's passiveinvestingmastery.com, and we have a lot for you there. We have an alternative investing mastery series you can opt into, and every 2 weeks be a live opportunity to meet a panelist of different investment types, of sponsors and different investment types, and ask questions in real time and get those answers. And we deep dive. So register for that. If you're interested in our alternative investments, litigation funding, right there on our homepage, we have it. I have a couple of free books on the website, just hours and hours of free resources. And I've got a bunch of articles for Forbes, all available there. And I'm going to have Matt Faircloth on my Mastery series coming up pretty quick here. So I'm excited about that. We're going to talk about hotels, the one and only. So jump over there and set up a meeting, regardless of where you're at in your career. I was once a hardworking professional, slaving away, trying to do everything I could and losing it all. And then sacrificing my time, family, and friends and hobbies for trying to get single family working all on my own while being a professional. And then finally figuring out how to scale and diversify in a way where, my wife and I could actually move to Hawaii and we could have a child and I could be more present at home and be in non-correlated alternatives. And so wherever you're at in your journey, I'd be happy to contribute and help you get pointed in the right direction.
And then you get to live in Hawaii, where you get to have the right to wear amazing shirts like you are right now. You get it's a Hawaiian shirt. You get to wear with it. Me, I look funny wearing a shirt like that. You look fantastic wearing a shirt like that because you live in Hawaii. So awesome stuff. Thank you so much for the conversation today and for joining us. I really learned a lot, and I hope our audience did too. And on the Best Ever CRE show. Thanks for joining us.
Thanks for having me, Matt.
Guys, great conversation with Patrick Grimes. I really got my mind blown with that. And I'm looking forward to I'm going to go out there to investwithpatrick.com myself and grab that PDF. I hope you guys do that too. I hope this is a good episode for you. If this was a good episode for you, do us a favor. Do yourself a favor. It's subscribe to the show. Share it with a friend. If you got a friend out there that is out there talking about investing and wants some alternatives, wants to get some off the wall ideas for ways they can make more money as a passive investor, share the show with them. They would love to hear what Patrick had to say. And subscribe to it so you can come and join me, your buddy Matt, every Friday here on the Best Ever CRE show. We can talk more shop, more next level stuff. Until then, guys, thanks for listening and have a best ever day.